Hi, my name is Sarah Megginson. I'm a journalist and editor with 15 years experience writing about property and finance, and I'm the senior editor of home loans for finder.com.au. I'm really thrilled to be presenting today, talking about maximising brand value through education. First, a little bit about me and Finder. So Finder is a comparison website where more than 2.5 million Australians turn to us every month to save money, time, and make important life decisions. We compare virtually everything from credit cards and phone plans to health insurance, travel deals, of course, home loans, and much, much more. And our whole goal is to connect brands with consumers. So at Finder, we conduct a lot of consumer research. We run monthly consumer sentiment trackers to examine how everyday Australians are feeling about their finances, including their mortgage. This has been really compelling over the last 12 months. It's been a bit of a roller coaster, but incredible to capture kind of in real time how Australians have been adapting to everything that's been happening. What it means for us is that we actually have a ton of insights at our disposal and a number of experts on our team who spend every day trying to simplify everyday money decisions for people so that they can make smarter and more informed financial decisions. So today we're going to dive into a few key topics to do with leveraging basically what has happened over the last 12 months and leveraging the opportunities from here so that you can really grow your customer base and meet consumers where they are today. Consumers have really changed their behaviors and their expectations over the last 12 months. So it's about looking at what we can learn from what has happened over 2020, what we can learn from that and adapt and use that as opportunities for this year and beyond. So we're going to take a little bit of a deep dive into what has happened during COVID, look at the key consumer insights and the impact that COVID has had, and most importantly, the opportunities that have come out of that. We're going to talk about the importance of building relationships by educating and not informing, because they're two totally different things, and also touch on the transition to digital and how you can leverage that. I mean, it's impossible to avoid going digital these days, but what you can do to really use that to your advantage and help you meet consumers where they are by embracing digital technology. Firstly, we're going to have a look at the last 12 months. I know that we've kind of talked about COVID to death. So many people have talked about different aspects of it, but we're going to touch on a few of the key things that have come out of it. The impact of COVID over the last 12 months has obviously really shaped the state of the mortgage market today. So much has been said about COVID, the pandemic, and the challenges we've faced. So I won't dive too deeply into the stats and the trends around mortgage holidays and financial stress and all of that kind of info that we lived so deeply while it was happening. But I do want to touch on some of the really interesting trends that have emerged. As I was saying at Finder, we do a lot of consumer sentiment tracking. And through this, we've found that over the last year, the number of Australians who are struggling with their finance right at the peak of COVID sat at about 77%. So, it's not an unsurprising statistic. That's almost or more than 3 in 4 Aussies who are struggling financially. I don't think we're surprised that it was that bad. But what has been really interesting is how quickly we've rebounded from that, that really kind of shocking part of the recession where people were going on mortgage holidays, where millions lost their jobs, where the economy was really struggling, where we fell into our first recession in over 2 decades. All of that has kind of played out over a very, very quick period of time. And that financial fallout of COVID has led to a really volatile economy and a really volatile mortgage market. We know that Australians have been really struggling, and we know that everything was really unpredictable and so much was unknown. But the way the mortgage industry reacted has been, in a couple of really surprising ways, has really impacted where we are today. So first of all, the first impact was obviously interest rates dropped. For the first time in a long time, they dropped substantially, and mortgage interest rates actually fell in half. So where at the end of 2019, where people were paying around 3.8, 3.9% for a mortgage, it's now possible to pay as low as 1.9%, sometimes even a little bit lower, depending on your deposit and things like that. So interest rates have collapsed in half. At the same time, mortgage repayment holidays became suddenly a very big thing. Our research shows that 1 in 10 Australians asked or were planning to ask their lender for a mortgage deferral in 2020 as a result of COVID. Many people were left jobless and unable to afford their bills. And that's a statistic that is, we are still dealing with that. We're not back to where we were. And the research shows that many Australians are still struggling. nearly a quarter of mortgage holders, or 23%, are still behind in their mortgage payments as of Feb 2021. The amount of people on mortgage holidays has definitely, a lot of people have dropped off, but there's still a really sizable chunk of people who are still needing to take that mortgage holiday all the way through till kind of the end of March, I believe, is when they start to wrap up. But at the same time, we have this really interesting juxtaposition where we've got kind of a two-speed market emerging, with demand surging from property buyers. First home buyers are really taking advantage of these low interest rates. And in some markets, property markets are starting to boom. I'm going to touch on that more in the moment and the opportunities that presents. But firstly, to kind of round off the COVID discussion, the pandemic has really altered consumer expectations for mortgage products and for what they expect from their lenders now. How people interact with their bank has really changed, and expectations have shifted. The really good side of that is that borrowers now have more trust in their lenders than they did before. It kind of used to be that common feeling that consumers feared their banks. They really hated going to the bank. It felt like, a really intimidating process. So they didn't really trust their lenders. They didn't really see you as someone they could lean on. It was more of a relationship that they had to have, one rather than one they wanted to have. What's happened now is that more borrowers than ever are trusting their lenders, but they've also got more of an expectation that you're going to be there for them, you're going to meet them where they are and help work with them. That's kind of the opportunity that has come out of COVID, has been that we've seen that lenders have really come to the party and helped consumers navigate this period. So it's shifted perceptions and it's shifted expectations. I think that consumers now have much higher expectations of their banks and lenders, but this is really where it provides an opportunity where you step up in your responses. It provides an opportunity for you to really gain a competitive advantage and build a relationship now that lasts a lifetime. To quickly round off on the cash rate, we now have these lowest interest rates that we've had since the RBA began tracking interest rate or cash movements. So we now have a cash rate of 0.1%, and as we approach the 0% cash rate, many home loan customers are going to be looking to switch. We had record amount of refinances last year, and that trend is set to continue right through this year. The opportunities for consumers to save money has really never been greater. So with record low interest rates and all of this volatility, it's created a hugely unpredictable market, but it's also been really favourable for a number of Australians. If you're one of those lucky ones that managed to keep your job, continue your income going, and you didn't really have a big economic impact of COVID, it means that you actually benefited from a much cheaper mortgage. And if you did have that income to support you, you probably could refinance to get an even better deal, or even perhaps a cashback offer. So for some people, 2020 has really been a benefit in terms of their mortgage, rather than a year of financial struggle. Right now, interest rates are a huge driver of activity, but they're not the only driver. We've seen a huge amount of government stimulus that's been propping up the market in the form of JobKeeper and JobSeeker. Before the pandemic, we had the introduction of the first home loan deposit scheme, which was capped at 10,000. They introduced a greater cap. They added another 10,000 to it last year. And it's just been announced that that's going to continue, or it was announced early in Feb. That's going to continue right through the 2021-22 financial year. It was they were looking at ending it this year, but they're going to extend it to next year. So that creates quite a lot of opportunity for first home buyers to buy with a lower deposit and take advantage of these low interest rates to get into the market. It's kind of a once in a lifetime opportunity for many people. But it's not just first home buyers. There are also the home builder grant, which gave $25,000 last year. It's now reduced to 15,000, but that's still a chunk of money that people can use towards buying a new build or build their own home. And then we've had a range of stamp duty concessions that have been introduced. In Victoria, the stamp duty has been wiped up until a certain value, and that lasts right through until June this year. So we do have a number of these kind of grants and stimulus packages that are on top of all the existing first homeowner grants and concessions that have been in the market already. So, many of these measures are due to start winding up in the next few months. We've got JobSeeker and JobKeeper ending at the end of next month. Many of the economists that I've been speaking to, doing, my interviews for my news stories and things, I'm always asking about, what they see ahead for the rest of this year. And it's a similar feeling around the end of JobKeeper in March that we had in September, where everyone talked about we were going to fall off a financial cliff, and there was going to be a lot of stress around it. And then when September 30 actually happened and JobKeeper reduced, there wasn't as much of an economic collapse as people were expecting. That's kind of the general consensus of what economists are expecting to happen at the end of March, that there will be, a change, there will be a shift, but it's not going to be as horrific as, perhaps we might be thinking that it's going to be. It's still really hard to predict what's going to happen. We still have really high unemployment levels. I think hospitality is one of the worst impacted industries, with still 300,000 people in hospitality out of a job today. So, there's still a lot of people who this is impacting on a day-to-day basis. So with these measures starting to wind up, how does this impact the mortgage market? And more importantly, what are the opportunities that it presents over the coming months? So what it really highlights is that with all of this change, it's never been more important for lenders to really renew your customer-centric strategy and approach, so that you can remain really competitive and be the brand that your consumers really want to turn to during this time. We've seen some big trends emerge this year around cashback offers and low interest rates. But I think cashback especially, it used to be the case that there was always one or two cashback offers in the market. Now there's usually at least half a dozen in the market. All the big four have had a go at offering a cashback offer over the last 6 to 12 months. Interest rates have also gotten really, really sharp. And when we're in an environment where everyone is offering really, really low interest rates and there's all these cashback offers abounding, there's only so much you can do to remain competitive when your offer is really similar to everyone else. If you keep your offer based around price, it's going to be hard to differentiate yourself. So what you really need to do is look at the value that you are really offering your customers. What reason are you giving them to choose you over all the other lenders in the market? And more importantly, what reason are you giving them to stay with you beyond this home loan transaction? It's really important to consider this now, because there are really big buying intentions for this year. I mentioned our consumer survey tracker research before, and a really interesting stat that came out of that is that 20% of Australians are looking to buy this year, which is the equivalent of 3.8 million prospective customers. And that's not refinances, that's brand new customers who are looking to buy a property in 2021. We've seen huge activity this year. Sydney's auction clearance rate the week before last hit a 24-year high, almost 89% of properties sold through auction. And we're seeing this huge kind of upward trend towards home ownership. COVID has obviously made people really think about their living conditions, where they are, and it's made them want to really put a focus on making sure that their home is their sanctuary and where they really want to be. We've also had the fact that people are not traveling as much. So, that $25,000 trip to Europe or the family holiday to Fiji and all of those kinds of trips haven't happened. And there has been really little opportunity to spend that money within Australia with constant border closures. It's been more like local staycations and weekenders rather than expensive week-long holidays and vacations. So people have more bigger deposits. They have that combined with the fact that interest rates are ridiculously low. It means that their borrowing power is suddenly, is right now, in February 2021, their borrowing power is so much greater than it was 12 months ago. And that really creates that once in a lifetime opportunity. Once you add in the grants and incentives and home builder and all the different kind of offers that are in the market, it creates this once in a lifetime opportunity for many to buy, to switch from being renters to homeowners for the first time. So first home buyers are the most active they've been in years. They comprise a really big chunk of the market, but they're not the only ones who are really active. Upgraders and downsizers and every kind of, sector of the owner-occupier market has been really busy. According to ABS statistics, owner-occupier home loans grew to a record $20.4 billion in December last year, which was a 12.4% increase on November. Even more interesting, it's a 41% increase on the previous year. So home buying activity was up 40% in December 2020 than it was in December 2019. And remembering that December 2019 was actually before the pandemic was on our shores. So it's really interesting to see that there's so much pent up demand kind of was just accruing and building up during the pandemic. And now it's really spilling over. More people than ever are keen to lock in the security of home ownership. So what can you do to help them turn that dream into a reality? This is where I think it really comes down to creating lasting relationships. And that means investing time in relationships now that will pay off in the long run, that maybe don't have an immediate payoff. And what I mean by that is it's always going to make sense to focus on where you can get the quickest wins and the most action, which right now is with first home buyers and refinances. But if you're willing to invest a little bit deeper up the tunnel and develop relationships with your clients earlier on, you can become a trusted partner that helps them become really mortgage ready. So there's going to be, with 1 in 5 people looking to buy this year, there's a lot of opportunities to work with people who are ready to, to buy in the next 12 months. But there's also some who are not ready to buy now, but they're ready to buy soon. These are the ones that really give you an opportunity to educate them and prepare them by advising them how they can get home loan ready sooner rather than later. So that's things like debt reduction, consolidating their debts into one, cleaning up their credit profile, reducing their discretionary spending, just kind of getting their budget in shape. There's things that you can do now to prepare yourself to buy in 6 to 12 months' time. If you start having these conversations with your customers now and you start becoming a trusted source and a trusted resource for them, it means that you're going to be the one that they turn to when they are ready to buy. The really good opportunity that you have here is that consumers are trusting banks more than ever. Our research shows that 58% now trust the big banks, which is an increase of 8% on this time last year. So it means that you already have that opportunity to start building that trust. And building trust really needs to be at the core of what you're doing to try and get these relationships going. And a core component of how you build trust is by educating and building financial literacy. You're actually already a trusted expert in a borrower's life. I've interviewed a lot of bankers and brokers during COVID, and they said sometimes, at the really most difficult parts when people were really struggling, they didn't know, bank phone call wait times were 2 hours and they were really struggling and just weren't quite sure what to do, who to turn to, or what to do next. Sometimes just sending out an e-newsletter that said, "Are you okay and how can we help?" Got a lot of responses because it just meant that you were kind of a port in the storm or a person that they could turn to say, "We don't actually know what to do. We're not sure what our next step is." And you then become that expert for them that can help them make the best and most, relevant financial decision for them. So in order to create these types of relationships and focus on that trust and communication, it means really giving them information they can rely on. This is the age of information overload. And if you want to form really genuine and lasting relationships with your customers, as opposed to transactional relationships, then you need to become that really trusted source of information. So over the course of the pandemic, as I said, we saw trust in lenders increase by 8% compared to the year before. And you can build on that by educating, not always just selling to your database, but by offering real value, guidance and support so that they come to lean on you in good times and in bad. It's a way that you can show customers that you're a brand that they can trust and a brand that they should choose. You can do this by becoming a trusted source of information and by improving their financial literacy. So how do you go about that? First, it's about understanding where the knowledge gaps are. Our research shows that 21% of consumers don't actually fully understand their home loan. The reality is that many Aussies have really crappy financial literacy. So they're kind of flying blind and don't really know. They don't know what they don't know. Financial literacy levels are so low, particularly when it comes to the more complex mortgage products. We work in home loans every day. So there's a lot of aspects of the mortgage market that we think are just kind of common knowledge, or that everyday people would understand, but it's not always the case. For a lot of people, they don't even understand the difference between a variable and a fixed rate, or the impact of ending a fixed rate, or what an offset can do for them. Regular borrowers often don't know this stuff, and it's up to you, or it's really an opportunity for you to educate them so that they're clear on it at the very beginning of their home loan journey. Another interesting stat that we found is that only 31% of consumers know the difference between a comparison rate and an interest rate. And, you know, I've got my own personal thoughts on comparison rates. I think they have a little bit of value, but considering they're anchored to a mortgage value of $150,000, they don't really provide a full picture for most borrowers these days. The average home loan size right now, according to the ABS, is just a touch under 500,000. So I think we would have a lot of value for consumers if we were able to benchmark the comparison rate against that. But at least it's a starting point, and it's definitely something that customers and borrowers need to be aware of, what the difference is between an interest rate and a comparison rate. Another interesting point is that more than 1 in 2, so 55% of consumers, think that the Reserve Bank sets mortgage interest rates. And it's really easy to understand the confusion there because, you know, when the Reserve Bank board meets on the first Tuesday of every month, there becomes huge discussion in the media about cash rates and mortgages and how it's going to impact your mortgage. So it's very easy to understand why, you know, that clear correlation exists in a borrower's mind. But the clarity that the Reserve Bank doesn't set mortgage interest rates isn't there. Almost 1 in 3 consumers also have never heard of a home loan provider offering a cashback on a mortgage. So there, as you can see from these kind of knowledge gaps, there is so much opportunity to educate and make sure that the people on your database are just getting the most relevant information to them and where they are in their home loan journey. Someone who is about to borrow, is home loan ready and they're about to borrow, then they're the ones that you need to be talking about comparison rates and offset accounts. Someone who's still 12 months off borrowing, that's not quite as top of mind for them. To them, you'd be better off educating them about how a credit card debt could impact their borrowing power, or, you know, how their credit file could impact the home loan interest rate they're going to pay. So there's different information you can share with people based on where they are at in their home loan journey. And the more value you can offer, the more that you're going to become a trusted partner to them. And so this really boils down to working out, what does your customer actually want? And there's a really big difference between what you are trying to sell them and what they actually want or need from you at this point in time. And this is a really powerful way to foster trust and to nurture your customer relationships, because mortgages have really been under the spotlight in the last few years. We've obviously had more movement and switching and refinancing because of the interest rates over the last 12 months. But before that, we also had so much attention from the Royal Commission. It seems like an age ago now, but it was only a couple of years ago that, you know, banks were in the headlines every other day for matters that didn't build trust with consumers. We also had a number of restrictions that have since been wound back a little bit, but if property prices continue to grow at the rate that they are, there's every chance that they'll get tightened up again by the end of the year. So all of this is kind of par for the course for us when we're in the industry. But for those who are just wanting to get a mortgage, they don't really understand the reasoning behind this, or for instance, they don't understand why they might be pre-approved for a certain loan value 1 month, and then 3 months later that loan value could change based on shifting policies, or, you know, APRA intervention, or a shifting appetite for investment loans versus owner occupiers. There's so much that happens behind the scenes that they don't understand. And obviously you don't have to go into granular detail with them, but just keeping them really engaged and informed about the aspects that impact them is going to really go a long way towards building trust. As I mentioned earlier, customers are now wanting and demanding more of the banks that they do business with. And I think if you can show them that you want to put their best interests at heart, and you can demonstrate that, then they're going to start to rely on you. And if you don't do that, there's going to be other banks and lenders out there who do, who are going to take that opportunity to kind of build that trust and swipe that customer. So, you know, I wanted to share a story that happened to me regarding kind of financial literacy. When I got my very first home loan many years ago, I didn't know what an offset account was, and I didn't have an offset account. Our stats show that at the moment, getting an offset account is a non-negotiable requirement for 42% of Australians, which means that there's still 58% of Australians who perhaps don't even know what an offset account is or how it could benefit them, or are not aware of the fact that offsets can save them a lot of money. I had a reader contact me at Finder a couple of weeks ago saying how can she find out what interest rate her offset account earns, and where is the money? Where is the interest? She can't find it on her bank account statement. So I had to explain to her that, you're not going to earn interest on your offset account. You're going to not pay interest rather than earning interest. So, there's a lot of confusion around some of these more complex aspects of mortgage products, and it's an opportunity for us to educate. So for my personal experience, my very first loan, I had $25,000 sitting in a savings account, and I was talking to a friend about it, and she asked me why I didn't have it in offset, and I had no idea what an offset account was. And I was really dirty. I had the loan for 3 years, and I'd had that savings slowly building. I think it started at about 10,000 savings, and it had built up to about $25,000, almost $30,000 by that point. And my friend said to me, well, the bank's not going to show you how to save money, are they? They're not going to tell you about this. And that made me really frustrated. And I thought, well, no, they're probably not going to tell me that I could save money, but they should. If you're willing to offer this product, and if you're willing to offer these opportunities for your customers to save money and to make the most of their finances, then you should actually explain to them how they can benefit from it. It was really frustrating at that time, because when I went to my bank to find out how I could get an offset account, obviously I was on a basic loan, which I didn't understand at that time what it meant. So I would have to move into a home loan package, pay a home loan package fee to get the offset account. And at the time in my early 20s, it all just seemed too hard, put it all in the too hard basket, and I just ignored it. That's where you really have this opportunity to be transparent and build trust with customers. And then you become someone that they actually lean on, and they think that you're going to be there to help them, rather than be there to, make this whole journey more confusing and more frustrating. If you genuinely solve a problem for someone, then they're going to become a lifelong customer. And it's going to be more than just the relationship of this one transaction. It's going to be the many, many home loan transactions they have over their lifetime. So the last opportunity that I wanted to touch on, which is a huge one, is this transition to digital that we've seen take place over the last 12 months. And this is really about serving people where they want to be served, or meeting people where they are in their lives. I can remember interviewing a Big Four bank executive last year. It was, I think it was the end of April, early May. It was right in the thick of all of the COVID craziness. The mortgage home loan deferrals were sky high, and everyone was trying to figure out how they could continue operating and doing business when everyone was shut. We were in lockdown across the country, and this was one of the Big Four banks that I was speaking to, and he said that at their particular bank, they had to innovate at the pace of 1 year in 1 week in terms of embracing tech, in terms of, embracing easier verification of identity practices, of digitizing that whole process, of moving into digital conveyancing, of streamlining, uploading of documents, and of allowing what has traditionally been a really, really paper heavy process and a paper heavy industry, just really, really quickly moving that into a more digital method. So we've now also got extra changes brought about by open banking and CDR. So when you add all of this into the picture, it's clear that we've had a lot of innovation and change over the last 12 months in terms of digitization, and all of that change is kind of here to stay. I don't think there's going to be many consumers who are going to be happy to go back to how it was in terms of having to front up to your bank to show your identity and sign documents in person and all that kind of stuff. I think the appetite for digitization is now really strong, and it's here to stay. And so if you want to leverage that, then you need to be ready to meet customers where they are. And that really means making the process of getting a mortgage as simple as possible. I can remember interviewing the founder of a mortgage startup a few years back. They might even be presenting at this summit. I think I saw their brand on the speaker list. But what really struck me during that interview was how willing they were to meet consumers or borrowers where they are. And by that, what I mean is when they launched, one of their big selling points was around meeting the customer where it suited them best. So when they prepared the home loan documents, that could mean that the customer could choose from a range of ways to get them. They could either receive the home loan documents in a PDF and print them themselves, arrange to sign them and send them back. They could have the home loan documents printed and couriered out to them, so they just receive it in the mail. They could arrange to come to you in person and sign the documents with you and bring them and do it all at once. They could arrange for you to come to them, to come into their office and sign it if that suited you better, or you could do it all through a digital portal. So there were 5 different ways and basically 5 different options to suit every different generation and preference and personality and work lifestyle. And, you know, if you traditionally, if you were a nurse who works shift work, you know, or if you worked in a job where it was really difficult for you to get into a bank and make it there between 9:30 and 4 p.m., it became a really big challenge to sign loan documents. So by offering all of these opportunities, it just really makes it easier and simpler to get the job done of going through your mortgage documents. And, you know, really at the end of the day, for most consumers, a mortgage is a means to an end. It's how they get realize their dream of home ownership or an investment property. A mortgage is not, you know, the part that they're focused on. They just want to facilitate getting into their property. The easier that you can make that journey for them, you know, the better experience they're going to have, and the more that they're going to become one of your raving fans who returns to you with more business and, you know, gives more business to, you know, refers you to other people as well. Our stats show that 2 in 5 Australians, so 40%, would be more inclined to apply for a home loan online rather than in person. So that's a pretty phenomenal statistic. That's almost half of Australians would prefer to do that online. And I think it makes a lot of sense these days. We're used to being able to transact pretty much whenever we want now. If we're on our iPad at the end of the day at 9 o'clock at night, kids are in bed, and, you know, you finally got a minute to yourself to catch up on things, that's a time when you might sit there and go, okay, I've got half an hour, I'm going to start looking at this home loan application. So this real, you know, this transition towards digitizing and streamlining processes, it's really becoming more and more the norm. And it actually helps to re-emphasize or help your customers connect with your brand in a way that it's a positive experience rather than a negative. I can remember myself, a few years ago, it was about 6-7 years ago, I got a home loan for an investment property, and I went through a broker to get the loan. And it turned out that the best loan for me was going to be with my existing bank. It was one of the big 4. And so I was like, not a problem. I'm still going to go through the broker for it because she did the work to find out the best loan for me. And when it came time to verify my identity with the bank, I had to go into the branch and verify myself in person, despite the fact that I had been a customer for 20 years and I had a customer identification number. Their process was, if you go through a broker, you have to identify in person. And as a consumer, that was beyond frustrating. It colored that whole experience and made it, to make it even worse, I was in Queensland. So here we need JPs to sign documents as well. So I had to, the process of getting that home loan was so clunky and frustrating. There were 2 days that I had to arrange time off work to go into the bank and go into a JP to get these documents signed. And it was so frustrating. We've come so far since then. And I think this is why it's so important, because you can now meet customers where they are, where they're used to being, where they're used to, you know, people are used to transacting online now. There's a lot of trust around transacting online. So if you're not prepared to meet them there, they're going to move on to another brand that is prepared to meet them there. We're increasingly digital. We live in an increasingly digital world. So if you lag behind on this, it's going to make a dent in your business, and you're going to see that people will turn to others that do have more innovative digital solutions. So that kind of wraps up what I wanted to talk about today. We know that COVID has really created a lot of volatility, but it's also really ripe with opportunities too. And I guess that's what I want to be the key takeaway today, that as we look ahead this year, there's more buying activity than we've seen in quite some time. All of the pent up demand from last year is now being unleashed. So we've got refinances, first home buyers, and just regular owner occupiers who are all, you know, keen to take advantage of these low interest rates and get into the market. So if you can nurture your existing and new customer relationships and build trust with them by educating rather than just informing, you're going to build this incredible network of borrowers and potential borrowers who really trust you and want to bring their business to you. So to grow your customer base, you need to be really agile, keep up with the transition to digital, and just be willing to meet people where they are. And you're likely to enjoy hopefully a much better year this year than you did last year.